Welcome back. Doné and Sheldon are still with us. We're turning our attention now to what tax breaks exist. So, Sheldon, a little bit earlier on, Doné was talking to us about the importance of meeting those deadlines, those window periods. And we also touched a little bit on about capital gains tax and investments, which then brings me to you. Let's look at the importance of getting professional advice, particularly when it comes to one's investment portfolio and how that relates to tax.
Well, I think not all of us are tax experts, and tax is ever changing, and keeping up to date with that, you require a professional to know that. And when looking at your investment portfolio and trying to structure it to get the best benefits that are available from that SARS allows you to get, like exemptions, such as an interest exemption, capital gains exemption or annual year, as well as more of the newer initiatives like Section 12B or 12J structure. Those things, you need the advice to know how best to place your capital to get those benefits, and hopefully that will boost your returns. Yeah. So like a Section 12B is put in place to encourage people to invest in renewable energy. So you get to put in 1,000 Rand into a solar panel, and SARS will let you take a 100% capital deduction in year one of that full 1,000 Rand. Yeah. So it's as if you've invested for nothing. 12J was set up to encourage new businesses to be started up with venture capital funds. And there you are also enabled to get some of your initial capital outlay up front, and which will help mitigate some of the risks that you face in kind of that venture capital space.
Okay. What are some of the misconceptions when it comes to a lot of these tax benefits that are out there? Because to some people, it's new information, it sounds exciting, but then when you go in there, you don't fully grasp what the implications are or how that involves you and how you change that relationship. What are some of the, misconceptions you've come across, particularly when it comes to tax benefits and the questions people ask?
Well, I think first and foremost, SARS doesn't like having to give 100% tax deduction up front. And we've just recently seen in the amendment bills that they're proposing to start clawing back on the Section 12J that Sheldon's alluded to, because it was such a very good structure, but also for an investor to get a good tax deduction as well. But in the long run, we were investing in our country and in the economy, but we had the 100% tax deduction. So it was really quite lucrative for investors who had funds available to invest in these sort of structures and these products. But SARS, on the other hand, has a job to do, and collection of the revenue for Treasury and the Minister of Finance. We've got a budget to meet. So SARS doesn't and would like to challenge some of those structures. But where the tax legislation allows and permits it, one is allowed to structure your affairs accordingly.
Any misconceptions you've come across in relation to a lot of these tax benefits you've spoken about?
There's always a misconception because it comes from the misunderstanding of how it works in terms of like how interest exemptions work. And often you hear people talking about tax-free savings. And that's where, I guess, a misguided attempt, people may be missing out on other benefits that are there. So you go into tax-free savings and all you're saving is the cap of 33,000 Rand a year that you can put in there. However, actually, if you have no other investments, you can take advantage of the interest exemption, that actually that income that you've earned of that investment is also tax-free. And that's the misconception that comes from individuals sometimes not understanding the full benefits that are out there.
Okay. So we've spoken about, tax-free savings, Section 12J. Are there other tax benefits that one should consider or at least have a conversation with your financial advisor about?
Definitely. So depending on what your marginal tax rate is, different conversations can be had. So if you are a high net worth individual sitting at the top of the tax bracket with a marginal tax rate of 45%, that is obviously a high tax rate. And that's where structures like endowments through a life company and wrapped in that life company, you can get marginal tax benefits from that, such as only paying 30% tax on the income that you've earned in that endowment that you've bought.
So things to bear in mind when completing your tax returns, tips you can share, things people can avoid based on some of the experience you've seen that you think people should know about.
The important thing about a tax return is that it's eventually a declaration that you make as taxpayer. And it's sort of an oath that you make to SARS. So you've got to be honest and truthful. It must be complete at the end of the day. And SARS has many avenues and means to verify the information that you do submit on your tax return. They've got third-party reporting. Banks, financial institutions, etc., do provide SARS with information. So you can't necessarily not complete your tax return properly without any sort of repercussions. And at the end of the day, as I said, it is a declaration that you make as taxpayer. But eventually, the tax return is a report of all of your income and your allowable deductions. So for 12 months of a tax year, it's a summary of those 12 months.
Things to bear in mind when completing a tax return, particularly if perhaps you are new to the investment space. I mean, our show, targets a lot of people who are probably new to a whole lot of things that we're talking about right now, and they, wanting that guidance to navigate through it. What should you bear in mind?
So one of the efficient ways that SARS has allowed us to complete our tax return is this third-party information, which comes actually pre-populated on your initial tax return. And I think it's important to individuals who are new to the investment space to make sure that it is complete, because with this being a representation and your declaration, you are ultimately responsible. So as much as SARS and the banks and the financial institutions have provided that data, you need to make sure that it's complete and accurate, and check compared to your certificates that you get on an annual basis. Because if you leave something out, there obviously is avenues that you can go if you've identified that. However, you wouldn't want SARS knocking on your door saying you filed an incorrect tax return and deal with those repercussions.
Because ultimately, even though e-filing is freely available to all taxpayers, and SARS is trying every year to make it more and more user-friendly, at the end of the day, the theory of tax is still complicated. So the practical filing of a return may have been made simple, but the legislation is still very technical, and it's legalese. That is why there's tax practitioners out there, as well as SARS enforcement, so that if taxpayers do have the necessary questions and are unsure, really, before one goes ahead and makes a mistake and has all sorts of other repercussions, rather reach out to a registered tax practitioner and one that one can rely on, or go to SARS for that sort of guidance.
Does that apply to those who may have been concerned? A couple of years ago, there was a discussion about whether cryptocurrencies are also, part of the whole tax structure. Where are we with that conversation?
There's actually, SARS has indicated about a year or two ago that the cryptocurrency should follow the core principles of tax, meaning what was your intention with the cryptocurrency. Now, I've got my own thoughts about that, but largely, if I bought cryptocurrency for long-term investment purposes, I can somehow get away with considering that as a capital gain, should I eventually sell it. But if I held the cryptocurrency for speculative purposes, trading, then any sort of movement on it would be for revenue account, and that is straight 45% if you're at that rate. I still battle to see how anyone can buy cryptocurrency with the volatility that we've seen many of the types of currencies to try and argue that it's for long-term investment purposes. But SARS at least allows you as taxpayer to make that decision.
All right. Well, do you want to add something to that?
So I like to just boil tax down to the simple nature of it, is that you need to declare your worldwide income of what you earn. If you're resident in South Africa, what you earn throughout the world. And that is almost irrespective of what the nature of the assets are. So cryptocurrency, if you invest in it for capital gain or for speculative, it's still income in your hands, and that's where you should be looking to include it. And if you're unsure, that's where a professional can advise you to make sure that you don't run afoul of the SARS enforcement.
All right, let's leave it there. Thank you so much. Thanks once again to my guests, Doné Howell, Director of Tax at BDO South Africa, and Sheldon Friedericksen, who's the Chief Financial Officer of Fedgroup. Don't forget to tune in next week when we continue our focus on tax, but look specifically at expat tax. And remember to share your thoughts and insights with us by tweeting at Business Day TV using the hashtag SmartMoney412.